We do think that the correction will be modest, maybe call it somewhere between 5 and 15%. I think what would create a larger risk would either be some threat to the global economy, such as sharply higher oil prices, or if there's evidence that the U.S. central bank was going to take a much more aggressive stance. We don't believe the latter is likely. And again, it's difficult to predict an oil shock, but our belief is that unless events deteriorate much more significantly in the Middle East, then we're not likely to see that either. So we do think that there's a prospect for a correction in the second half, but it would be a modest correction, and investors should probably look at that as a buying opportunity. Is that even if the labor market's getting better, if fewer people work, and if many people are not getting a raise, then it's hard for people to increase their spending. And in particular, many of the consumer stocks in the U.S., which are very expensive, and they're expensive based on the fact that spending will increase. I think those segments of the market are vulnerable because if people can't earn more, they can't spend more. And that's where I think the problems in the labor market may come back to affect certain parts of the U.S. stock market. Many parts of Asia, particularly the emerging markets, but also Japan, look inexpensive. Chinese equities, for example, are trading about 9 times earnings. There's a lot of pessimism that is embedded in the price. And at a time when, as I mentioned, there are very few bargains, there are large parts of the Asian equity market that look inexpensive. The second reason I think you're seeing some turn in sentiment becoming slightly more positive about Asia. So I think as we have more evidence that China is slowing but not crashing, that's helping to support the positive turn in sentiment about Asian equities. In terms of Hong Kong, again, I'm going to defer to my colleague Andrew Swan about the specifics of Hong Kong. What I would say is that in general, we do think you're going to see in the back half of the year, and this is not specific to Hong Kong, is that there is going to be, and there already has been, increasingly investor focus on geopolitical issues. We do think that China will be growing in, call it the 6.5% to 7.5% range, which will represent a slowdown from the last few years, but still is going to be positive for Chinese equities, since that still is a relatively good outcome given some of the more pessimistic forecasts.